Hey everyone, it's Larry Berman here. It's coming up on holiday time. I'd like to wish everybody the best of the new year and everything, great health for your families and it's the kind of time of year where I like to wind down a little bit. So this is going to be my last YouTube cast for the year. Um, I typically and historically, the last Berman's Call show and now the last YouTube shows are my forecast for the next coming year, my fearless forecast. So be doing that this week on BNN, which will be my last show of the year, and so here too. So I'll go into a little bit more detail than I can in just a couple minutes on BNN. So let's dig into the chart room and see what the crystal ball has in store for 2024. One of my mentors in the technical world is a gentleman by the name of Ralph Alcampora. Many of you may know who Ralph is, but I suspect a lot of you don't. He hasn't been all that active in recent years, but he was the founder of the Market Technicians Association way back in the 60s and 70s in New York. When I did my internship on Wall Street nearly 30 years ago, I spent some time with Ralph and I learned from him about forecasting markets. And he made a very famous forecast, Dow 10,000 in 2000 back in the 90s. And, looking at the bottom up, each individual stock in the market, forecasting from the charts where it could go, doing the weighting calculation, and then seeing what the index comes out to. So that's the bottom up method. The top down method is simply looking at the chart and figuring out where that might go. Now, fundamentally, and I do have my fundamental hat on half the time, I like to know where the street is and where consensus is and where all the smart people on Wall Street, think markets are going to go. We know from watching these people historically who are the cheerleaders. We know who are the perma bears. And you all ought to know that I'm not a perma bear. I'm a manager of a risk. And I talk about the bearish stuff and I get the perception of being bearish, but I'm certainly not a perma bear. However, having said that, I think there's a lot more challenges, economically speaking, when I look forward than there are tailwinds at this point. So from a macro perspective for 2024, the street forecast is 4777, rounding up to 8, basically where we're sitting today at 4719. And so virtually no upside for the market next year. But the strategists are forecasting 6% earnings per share growth. And that gives us a multiple of 21.68 trailing and 20 and a half times, forward estimates. That's way, way, way too expensive for the climate that we're in. Nevertheless, we're here. The markets are exuberant over the Fed pause. And for now, risk on. We'll see if it lasts. I suspect it won't. I suspect interest rates will come close to a floor pretty soon. But if you think rates are rallying because we're going into a recession, you can't be bullish on equities. If you think rates are falling because the Fed is going to ease, they're not going to ease that much because inflation is sticky. We've got demographic challenges around labor markets, and I think that makes a lot more sense than does the cheerleading that we on average hear from Wall Street strategists. So that's kind of the top down. When we look at the bottom up, the Ralph method, this is a fundamental method. So we'll take each individual stock in the marketplace, look at the consensus analyst forecast, and then weight them by the index weights. And so that number right now is 5079, as you can see here, this white line. Rarely and historically do we get close to one standard deviation. Remember, this is every stock hitting its target, 12-month target, at the same time within 12 months. So that's impossible. It'll never happen. And you rarely see us get that close. So statistically, when we're below this blue bar, markets are pressing heavy on the accelerator in terms of valuation relative to realistic price targets. Now, of course, the analysts aren't always right, but on the flip side of the coin, and again, we never know with certainty, but when the markets are selling off and the price target is up here and it's a reasonable price target, then there's some advantage. And we were more optimistic here on a valuation perspective. Our modeling was more than where it is today now. We had said we thought we could come back down to the 3,600 level. So is that in store for next year? Well, based on the Fed pause and the fact that they're not going to raise rates anymore, or not likely to, if we get a hard landing and those earnings estimates come down, that's a big risk factor. Will we go through those lows from last year? At this point, it looks unlikely to, unless it's a really hard landing. And that risk is still there, but it's obviously lessened with the stance, the new stance of the Fed, being more accommodative. If inflation starts to uptick and the Fed walks back all the rate cuts that the market's priced in, you can bet 2024 is going to struggle, and that we would probably end the year somewhere close to, again, if earnings are $200, not $230, that same 20 multiple, which wouldn't be likely in a recession, but that same 20 multiple is 4,000 on the S&P. So, I think lower, we're going to miss to the downside in 2024. By how much? It's going to depend on lots of other factors. When we look at the NASDAQ, we can see how close we are, again, to the forward-based price target. This is the NASDAQ 100. And we're really close historically to where the analysts think full value is. We can see what happened a few months back and how close we got to the one-year price target. We're not quite that close now, but we're pretty darn close. So the markets are priced for perfection at this point. Don't make any mistake about that. When we look at what's happening under the hood, so this week, this is the performance of the top 10 and bottom 10 NASDAQ 100 names. Now you can see here we're looking at the Q. We're looking at the 5-day performance. And you can see the names on the top of the list are not the names that you would expect that have been leading all year. Microsoft, Google. If you expand this list out a little bit, you can see the rotation that's happened this year. A lot of the money's coming out of the more overvalued names and went into the names that have been beaten up all year. And so that rotation is happening. It's still happening. It started earlier this week before the Fed. We saw a very unusual day on Tuesday, I think it was, and partly on Monday, where the big tech names were down, Apple, Microsoft, etc., the Mag 7. But the NASDAQ was actually up on the day. It was very, very unusual and rare to see. So there's some rotation going on. The breadth is improving. The market rally is improving. So that's a thumbs up. That's a good sign to think. But it's more because money's having difficulty paying what it's paying already for the leadership names. And if we are going to get a soft landing and an ease, then the companies that have been beaten up should theoretically do better. The reality is we probably land somewhere in the middle. Again, TBD on how that all plays out. But my guess at this point is that we're going to miss to the downside. How much, I don't know yet. There's definitely major resistance that we're in front of. We can see this on the NASDAQ 100. We're getting close on the S&P 500 to the highs in 2021. When we look at the chart from a PE perspective, a more normal PE for the NASDAQ 100 is somewhere closer to 20. Again, this is a forward-based PE, and we're now at 30. And this is what happened during COVID. So, should we be trading at 20? Well, if we get a recession, absolutely. But if we get a soft landing, maybe 25 is the downside. um, or the median more likely versus the closer to 30 that it's trading at now. One of the reasons for the higher multiple has been said that it is lower rates. Well, we're past the low rate regime. If we look at the rates of the last decade, we're at like 2 to 3%, 10 years was where we were. Now, some are arguing that we'll go back to that. That'll happen if we end up with inflation between 1 and 2% again. And I'm going to argue no, it's going to be sticky around 3, and it's not going to get below that this year on average. It might dip below that mathematically, but I don't think on average we will see it there. So if that's the case, you're not likely going to see the 10-year break below 350, and there's not a lot of value left to me with all the bond supply coming. What hasn't changed? What did change was the last quarter QRA when Janet Yellen chose to fund a lot of the newer money that they needed in the bills market over the coupon market. Now that coupons are cheaper, I suspect in the next QRA, which we'll get that announcement the end of January and the first couple of days of February in terms of the composition of coupons versus bills, that they move back to more normal balance, in which case we need a lot more coupons, in which case this bond rally, at least for now, is over. So that's kind of the lens I'm looking at, and therefore the multiple shouldn't be where it is, and we'll see how that all plays out early in the year. But for those looking at a long bond rally to persist, I'll give you the 10-year down to 3.5, but I'll fight you tooth and nail to get lower than that at this point, unless something dramatic changes. Now, if we go into a real hard landing with economic grief, then the budget deficit gets worse. They need more bonds, not less. And so what's the market going to pay for that? And I would still argue it's going to be tough to get it below 350 at that point. So I'm saying the bond rally, there might be a little bit more squeeze to go here, but I wouldn't be making big bets on duration at this point. I know some others have different views. On the gold front, if the Fed is going to start cutting aggressively, then gold is going to rip again. And so we saw gold come off. Fed makes their dance, says we've had this perfect landing, and gold rips on Wednesday, Thursday. Waller walks back that rate cut expectation on Friday, and gold comes off. So the interest rate sensitive play, gold is being a big one of them. Gold will break out to new highs here. Remember this fake breakout we saw here? Not fake breakout, but big reversal after the breakout. Illiquid conditions. That is going to be major resistance, as it was here for most of the year until the Fed actually has to ease enough that we get to negative real rates. And I just don't see that in the short run. Eventually, yes, but this is one reason too why gold equities are still, relative to gold prices, are trading at such cheap valuations. The market just doesn't believe that a rally is sustainable here. And for now, I'm in that camp. But I do want to accumulate precious metals and gold stocks on weakness. What's weakness? You could argue that weakness is in the 1800 handle. You could argue weakness is in the 1900 handle. I'll throw it up for discussion, basically, but anything below 1900 for gold and gold equities at that point, it's got to be a screaming buy. So I've got my puts written for the first part of the year to accumulate, but right now I'm market neutral. I've sold some calls, I've written some puts, and I'm hoping to buy a dip. I don't think it'll trade away on us. When we look at crude oil, wow. So, looking at a long-term perspective, prior to the big moves, 15 years ago, where we were running out of oil in the world. Um, gold or oil was pretty happy between 20 and $40. And then 40 became the new floor. And even in the Great Recession, it dipped into that range, but obviously we recovered nicely from it. But we haven't made a higher high. And I don't ever expect us to make a higher high. I think the dynamics of demand and supply, I get the bullish story. People in Alberta and out west who are the energy bulls don't hate me, but this is just my lens of the world. I think we're going to hit peak oil demand far, far earlier. And so are we going to go back to this base? We are if there's going to be a recession, for sure. I know the narrative on right now, and I think very supportive for this year, is the buyback of this SPR. And that probably, as we zoom out here, puts a floor just around the lows of the last year, 65 to 70. I think they replenish the SPR. I think China buys all it needs. India buys all it needs. And, we're good. But if the global economy slips and we get a hard landing and China can't stimulate, then we're going to get a lot of speculation on the downside here. And that's probably the bigger risk versus this breaking out on the upside. Now, geopolitically, if the war escalates in the Middle East, Iran gets involved, those are all kinds of wild cards I don't want to forecast. I hope not. I fear it might. It's a narrative that is going to be front and center for all of 2024, sadly. I don't think there's going to be a resolution to the Israel-Hamas, call it Iran war, anytime in the short run, short of Hamas laying down their arms. And having said that, the current administration in Israel and the way their political system is designed right now is prohibiting a two-state solution. And I think that's what's needed. And so until the world comes to that conclusion and Israel's on side with that, I think there's going to be heightened political uncertainty in the Middle East. And that, in theory, should keep a bit under the energy markets as well. And then finally, the Canadian dollar. And so if we're generally range bound, I think the Canadian dollar is to the best levels of the year. Remember, Canadian dollar trades in inverse terms. The factors that drive the Canadian dollar are the spread between interest rates and the inverse price of crude oil. So when crude oil is strong, actually this graph should be no, this is the right way. So when crude oil is weak, as it is here, that would be negative for the Canadian dollar. When the spread to U.S. rates, the green line here, so this is the spread between Canada and U.S. 2 years. Right now, the Canadian dollar is rallying a little bit on what the Fed and relative interest rate policies, but this to me is not sticky. Can we get a little bit stronger for the Canadian dollar in the short run? Yeah, sure. But, with the ECB saying, no, they're not going to be aggressively, cutting rates, the momentum is tilted towards the Fed at this point. It doesn't make sense to me. I think the ECB and the Bank of Canada cut well before the Fed, but that's not what the Canadian dollar is saying at the moment. And ultimately, I think we get back to the top end of the range around 139 at some point during the year, with the potential to see it weaker if we get a harder economic landing at some point in 2024. Anyways, that's my fearless forecast. Have a great holiday season, everybody. Wishing everybody, whatever you celebrate this time of year, for health and happiness with your family. We'll see you in 2024.